Hi everyone, today we are going to explore the concept of economics, which is national income. Before start, let me introduce that what national income actually is. In simple terms, national income is the flow of the goods and services by a nation over a period of time, which usually a year. National income can be also defined as the total payment received by the factors of production in a country during a year. To be more understand what is national income, there are economics that define the national income through their understandability. The first economist is Alfred Marshall, who described national income is the total value of goods and services that had produced in a country each year. Marshall pointed that the value of goods and services are created by the labor and capital with the natural resources. Foreign investment should be included as national income as it adds to country wealth. Next, economics Irving Fisher had a different perspective on national income. According to him, national income or the national dividend is about the value of services that have been given but not the production of goods. Which he means, national income is what make up if the services that people actually use, whether the services come from things or from people works. For example, if a piano made on this year but didn't be sold, the piano can just considered as inventory but not national income. Since the national income is briefly introduced, now we are going to explore how the national income performs in economy. National income is a measurement for us to know how well the economy is performing, whether it is growing or contracting. Therefore, the national income accounting is now being introduced as it is the method that used by economists to measure the total economic activity for the country. In national income accounting measurement, the two important concepts is GDP and GNP. The figure below shows the cellular flow of income in four-sector economy. In four-sector economy, national income can be calculated by the formula C plus I plus G plus X minus M. Assume that we are in a nation with four-sector economy. We are having household, business, government, and also foreign sector. Through the formula, C is consumption, which represents the spending by households on goods and service, while I is stand for the investment that refer to the spending by the business on capital goods. Next, G is government expenditure, which including all the spending by the government. The last one, X minus M, is representing the net export, which is the difference between a country export and import. By using the formula, we will get the value of national income of the year for the country.
So as mentioned previously, GDP is a measurement used in calculating the national income. GDP, or its full term is Gross Domestic Product, is the total market value of final goods and services produced by factors of production within a country in a given period of time. In order to understand the meaning of GDP better, here are four important keywords that we need to memorize. The first one is market value. Next, final goods and services, which refers that goods and services produced for final use. Next keyword is within a country, which simply means GDP involves only domestic production. Last one is certain period of time, or normally a year or a quarter of a year. GDP also relates to NDP, which is Net Domestic Product, which is total value of new goods available in the economy in a specific year after worn-out capital goods have been replaced. As you can see on the slide is the graph of GDP growth since 2016 and latest update from the Department of Statistics Malaysia or DOSM for the third quarter of the year, which is 2024. It shows that the Malaysian economy has expanded by 5.3%. So moving on to methods we can use to measure GDP in national income. There are three different approaches, which are expenditure approach, income approach, and production or value-added approach. So for expenditure approach, GDP is measured using the sum of consumption expenditure, investment, government expenditure on goods and services, and net exports, which can also be represented as the equation C plus I plus G plus X minus M. So we can measure GDP in market price and also factor cost. For market price, we use the equation and plus with changes in inventories, while for factor cost, we use GDP in market price and minus with indirect taxes and add with subsidies. The first component for the equation, which is C, personal consumption expenditures, which consists of household spending on consumer goods. Next is gross private domestic investment. Another component for the expenditure approach, which is the government expenditures or spending. We excluded the government transfer payments to persons that are not made in return for goods and services currently supplied. And the last component for the equation, which is X minus M, which is net export. Here are the data from DOSM, where they divided the GDP according to the components of expenditures. GDP in national income can also be calculated using income approach. In order to calculate GDP using this approach, we need to find the national income first using several components here. The first one is compensation of employees. Next is proprietors' income. The third component to calculate national income is corporate profits. The next one is net interest. And the last component is rental income. So the equation to calculate GDP using the income approach can be referred as GDP equal to national income plus depreciation plus indirect taxes minus subsidies plus net factor payments to the rest of the world plus others. Since Malaysia didn't apply the income approach in the economic system, here is the attachment of GDP calculation using income approach from Canada in the year 2006. So the third approach that can be used to measure GDP in national income is called production or value-added approach. This approach measures GDP by measuring the output of each sectors in a country, for example, manufacturing and agriculture.
Next is personal income. Personal income, which is PI, is the total income that actually received by individuals and households in a nation during a year. Personal income includes wages and salary, rental income, interest and dividend, business profit, and transfer payments such as unemployment benefit and pension. There is two things that are excluded from the NNP to get personal income, which is insurance and income tax. Also, there is formula to calculate PI. So we need to have the national income and then minus undistributed corporate profit, minus social insurance taxes or EPF, minus corporate profit taxes, plus transfer payment, and we will get the real personal income. So next is disposable income. Disposable income is the amount of money that individual or household has to spend or save after federal, state and local taxes and other mandatory charges are deducted. So disposable income is also known as take-home income. Why take-home income? Because it represents the portion of income that we take home after we pay the personal taxes. So the formula to calculate disposable income is we take the personal income and we minus the personal taxes. There are three importance of disposable income, which is the first one, it determines how individual spending on goods and services. The second one is it affects our saving and investment. And number three, it also plays a crucial role in driving economic growth.
Let's move to GNP, which is gross national product. GNP is the total value of all the final products and services produced in a given period by the means of production owned by a country residents. GNP starts with GDP, gross domestic product, adds residents' investment income from overseas investment, and subtract foreign residents' investment income earned within a country. Here the formula GNP equal GDP plus NFIA. So GDP was explained before this, which is the total production within the country in a certain period of time. Net factor income from abroad, which is NFIA, is the difference between income received from abroad for rendered factor services and income paid towards services rendered by foreign nationals in the domestic territory of a country. NNP stands for national product, an economic metric that measures the total market value of all final goods and services produced by a country's population over time. It provides a snapshot of the health of a country's economy and the true value of its output after taking into account the depreciation of capital goods. It can also be broken down further into national income, which includes income for businesses. NNP is also referred to as national income at market price. National income at factor cost is defined as the sum of all income payments made to the factors of production. It is also, like gross national product, the total value of a country's annual output minus the amount of GNP needed to purchase new goods to maintain existing stock, known as depreciation. The relationship between a country's GNP and NNP is similar to the relationship between gross domestic product (GDP) and net domestic product (NDP). NNP is often reviewed annually to measure a country's success in maintaining minimum production standards. Despite its usefulness, NNP has several limitations as a macroeconomic indicator. Income and wealth distribution. NNP does not capture the unequal distribution of income and wealth within a country, making it inadequate for assessing whether economic growth benefits all citizens. Environmental impact. NNP ignores negative externalities such as pollution and environmental degradation, failing to take into account the environmental costs of economic growth. Policy implications. These limitations make NNP inadequate for guiding policies aimed at inclusive and sustainable economic growth.
I want to explain the real GDP and nominal GDP. Nominal GDP is referred to the total market value of all product and service generated within an economic over and a specific time frame, while the real GDP is the total value of goods and services produced from an economy in the passive. Here is the formula for the real GDP, nominal GDP, price in that year, and another formula for the real GDP. I will explain the difference between nominal GDP and real GDP using this table. This table shows the calculation of GDP for 2 years using the price and production of 3 production, which is orange, biscuit and chocolate bar. Firstly, I want to explain about price in the year 1 is 210.80 divided by 210.80 and multiplied by 100 equals to 100. The second is price in the year 2 is 219 divided by 223 and multiplied by 100 is equal to 89.21. Finally, real GDP can also be calculated using this formula, which is 219.00 divided by 0.982 is equal to 223. I want to explain the limitation of GDP. Firstly, is non-market transaction. It is only marketable goods and services are included in the GDP calculation. For example, if stay-at-home parent take care of the household chores, this valuable labor is not included in the official economic measurement. After that is underground activities. These activities do not exist in official document. They are difficult to determine. For example, is a person earn money through illegal, which is selling fake goods. This income is not captured in official economic data. The measurement of a country's total output. Lastly, the leisure time is very important in terms of social welfare. For example, in countries where people have shorter work week and longer vacation, the economic might appear less production in GDP terms, even though citizens have a higher standard of living and well-being.